and welcome to Global Mantra Outlook 2014. We are back again with another season of the show, interviewing prominent fund managers from the City of London and getting their outlook for the year 2014. Joining me on the show today is Nikhil Srinivasan, who's the Chief Investment Officer at the Generali Group. He oversees in his capacity as CIO almost $650 billion. Nikhil, it's great to have you on the show. Thanks very much. Let's begin by talking about Generali's investments. Largely, Generali's assets are invested in Europe.
That's right.
So to that extent, maybe the portfolio is insulated from what happens in the US. But just as somebody who's watching Europe closely and has an eye on what's happening in the US, what parallels are you drawing between the recovery cycle in Europe to that in the US?
Well, I mean, the US has obviously had very loose monetary policy for a period of time. That's benefited the US. Now, we aren't back to what was trend growth in the US, but we're back to somewhere, say, halfway between what trend growth used to be and what it left off at. Whereas in Europe, you've had essentially relatively tight monetary policy. And of course, we had an interest rate cut this week and things are getting looser. But overall, if you look at just the ECB's actions, it has been much more cautious in terms of its monetary policy approach, and that's had an impact, alongside the fact that reform in Europe has actually been relatively slow in the last few years. So the US is, I think, well ahead of Europe. Short answer.
The markets in Europe this time have surprised everybody. Germany, of course, has done well, second year on the trot, but the other markets have pretty much caught up. UK has done really well as well. What do you think this optimism is signaling?
Well, look, I think, first of all, Europe has underperformed for a very long time, continental Europe. I mean, it's underperformed the US markets, emerging markets, so its time had to come. But more importantly, I think what it's signaling is that we're probably we are at a bottom, essentially. And I think people a year ago, 2 years ago, were talking about the breakup of the euro. And I think people have finally realized, those who don't live in Europe, those who live in London or those who live in the US or wherever, that that's not going to happen. And I think as you start to realize that's not going to happen, you get much more confidence in terms of investing in stocks or bonds of European countries, particularly in the southern part of the continent. And that's really been positive.
The ECB, like you pointed out, has gone ahead and cut rates again. Whereas in the US, they're talking about potential rate hikes, tapering,
sure,
pulling back on all the money that's in the system. Do you think this move is sustainable? Do you think Europe can continue to be in a low rate environment? How do you see the rate cycle playing out?
I think Europe will be in a low rate environment for a very long period of time because there's a serious risk of
even if the Fed decides to taper and go ahead with rate hikes?
For the time being, yes, because I think what Europe has to worry about is the very low inflation prints that are coming out. And what I looked at the numbers this month, there was CPI at 0.8. And I'm not a deflation scare person. I'm not saying Europe is heading into deflation, but there are lots of similarities between Europe today and Japan in the 90s, where you had low growth or no growth, essentially no inflation, very strong currency, and very driven by a very large current account surplus. So, and what Japan is a reminder of what can happen. You can be in a funk for a very long time. I think what the European Central Bank is doing is trying to ensure that funk doesn't happen for a very long time. And so this is one of the outputs of that, and that is you cut rates again, and they've cut it to 0.25. I don't think we see deflation in Europe, but I do think there's a fear of extremely low inflation, which is worrying in its own.
Could Europe dip back into a recession? Is that?
But it's always a possibility, yeah.
How are you looking at the US story? Second quarter of 2014, you think tapering would happen?
Between December and June, I'd say it happens. It could be as early as December, it could be as later June, it's going to happen. Okay, it's going to happen simply because the mood is shifting on the board. Okay, and that's all it is. And also at some point, you've got to start at some point. And also, they've awkwardly signaled to the market they're going to do it, right, earlier this year. So it's not such a big issue for me. You could talk about whether US fiscal policy is right, you can talk about broadly monetary policy is right, but it's going to happen.
It's going to happen.
Yeah, it's going to happen.
Okay, and do you think the market has priced that in? Because there's just so much nervousness. Will they, won't they, when will they?
Look, the market has never priced anything in fully, even if it's expecting something. So if it happens tomorrow, the stock market's going to go down. Okay, but you've asked yourself, is the stock market going down because of tapering? Or is it going down because it's just had a massive, fantastic run of the last several years? And it's more the latter than the former.
But you know, the interesting point there is, while there's been this fantastic run and the markets are at all-time high levels, not just in the US, but some of the emerging markets in India as well. The point is, over a 5-year period, we're pretty much back at the same levels that we were at in 2007. So on a net basis, the market has not really made great returns. It's just that we've come back to a point where, you know, the expectation is whether we'll go up from here or whether the situation will get worse.
Yeah, well, if you look at technicals, you'd say you'd want to be selling now and waiting to see whether it breaks out. It's broken out a bit, but I don't know. I mean, again, I don't want to come across as particularly bearish on the US. I'm not. I just think that things will happen, tapering will happen, the markets will correct, and the markets have a fantastic run. Having said that, there's no reason to say, well, you know, the market's going to crash. But, you know, a correction in the US market is long overdue.
But if investment comes in from the corporate side in the US, which is the expectation, even if there's tapering, there's going to be expansion, and that's going to result in better earnings or a reversal in the earnings cycle. Wouldn't that lead to
sure, I mean, again,
in the markets?
Absolutely. I'm not here to say the US market just goes down a straight line. I'm simply saying, if you ask me, take a 3-year view. Today's end of 2013. You want to invest money through the end of 2016. Where would you be overweight? I'd be overweight Europe.
What about emerging market allocations? I mean, how are you seeing the trend there?
We've got money in the emerging markets. The emerging markets, from a credit point of view, depends. It just depends on where you are. I'd say Asia, generally, I'm not so worried. Okay, other parts of the world, I'm a little more thoughtful about. China, I'm more benign China. I think China can continue to grow. What is the 6-7% thing versus the 10%? Okay, I mean, so what? I think, can they do it 6-7 for the next several years? Yeah, they can. You know, I'm on the optimistic camp as opposed to the world's going to end in China camp. And again, there are issues. There are certainly issues in terms of investment or malinvestment, as you may call it.
Deflation pressure coming in there.
Potentially, but you know, it's a sensible, thoughtful, clever government. Okay, and I think that everything you and I know, they know. Okay, the question is, can they do something to work it out? They're not going to be able to give you 10% growth for sure, but they're going to give you something that's acceptable. I think Chinese stocks are not expensive, okay? And they haven't performed.
But they haven't been expensive for a long time, and money's still not been going in there.
No, I know, but I think what you have to look for is what the government has in terms of growth policies, okay? In terms of what they're going to do. My own sense is that this could be the time to actually buy Chinese stocks. So in a 3-year view, since I've talked about 3-year views before, I'd be long. In emerging markets, the stocks I'd be long would be Chinese stocks, period. If you ask me one country, China. Buy China, don't worry about it.
What about India?
Good question. I think the Indian stock market had a fantastic rally in the last few weeks. Maybe too far. There are two issues that they're just broadly speaking. One is you got inflation. You got an inflation situation, so relatively tight monetary policy cannot be loosened. Okay, for the time being. Second, you're coming into election season. Okay, so for those reasons, I'd say the market remains, at best will remain stable here. The issue then is the market starts to speculate on the new government, and if they believe a new government is going to produce those reforms that are needed, the market goes up. So then the catalyst for me is the next election.
Do you think emerging markets or these Asian markets can continue to do well in 2014 if we see an environment where money is withdrawn in the US? Because a large part of their story has been really liquidity.
Yeah, very good question. If you start to see some significant tapering and US 10-year yields go back to 3 plus, which I don't think they'll go beyond, because I think given where US nominal GDP growth is, I don't see 10-year bonds at 4%. It makes no sense where inflation is today. Yeah, that's going to be an issue. But I think that's going to be an issue more for the stock markets. I think if you enact good policies, you will get foreign investment. And I think India is disappointed for a very long time on the policy front. You can blame whatever you want to blame, but it's time for ending the disappointment if you really want the foreign investment to come back. So I wouldn't worry so much about tapering. I'd worry more about enacting good policy.
So what would be your broad view on India for the new year?
I mean, depends on the election. As you say, if you have a government that's willing to take the tough medicine, or if you can start to anticipate that, then the markets are going to go up. Because it's really the election that's the driver right now. You're not going to see rates coming down that much. You're not going to see interest rates coming down that much. You cannot assume that's going to be a driver. So what's going to drive is purely politics and the consequence of a new government and what they might say before election and do after the election. There's the foreign investors. The good thing about India is people have put money in, they haven't taken much money out. even when markets went down, even the currency went down. That's good. That shows money is relatively sticky. Okay, but the question is, can you attract new money? And more importantly, can you attract FDI? And that's just stickier money. There are two types of foreign investment that come in, the portfolio flows and the FDI, right? And it's the FDI India needs, and it's falling way behind on that. And that's really what matters. And that's where policy effects come into play, right? And I think FDI is really what it's all about.
So if you see more reforms on that front, if you see opening up of sectors to foreign flows and long-term flows, would that build a case for turning bullish on India?
Well, absolutely. I mean, even if you just see a government that starts to enact a few things, right, that makes you very bullish.
Infrastructure is a big theme in India, and you know it's being touted as, of course, a big source of getting in foreign funding and foreign capital. How are you looking at the infrastructure story, particularly in India? Well,
if I remember, infrastructure has been a big story in India for a very long time. Okay, so this is not a new story. It comes back every few years because people realize they haven't done enough.
Well, the government is really pushing to get in capital, especially on the debt side.
We can do a deja vu on this, and I'm sure you have, 5 years ago, 8 years ago. Look, it's logical that the government would try and get capital from abroad, but the government should also get capital from home, because the savings rate in India is very good. So why not channel some of that savings into infrastructure debt? So I mean, I wouldn't always just look at foreign capital. I'd look at capital at home as well, because if the project offers good returns, infrastructure funds can raise a decent amount of money. And if people feel secure about their returns, that the return, it's a good project, and get their money back, they put money in that.
What's your view on infrastructure in India?
Badly needed. Just like in Brazil, just like in Indonesia, all the countries people like to talk about. We've been delayed in building the requisite infrastructure required. So hopefully, after the election, the new government, whichever it is, whichever party, will start to make this a priority. And you get money, and if you start to get money domestically initially, foreign money will follow. I think this whole thing about getting foreign money sounds good, sounds cool, right? Let's get money from abroad. My point is get money locally. If you get money locally, the returns are decent, stable, steady, okay? Then over time, foreign money will come in, okay? Or you do joint projects, or you set up in India some kind of guarantee bank, guaranteed by the government, issued by the government, and the guarantee bank, whatever you want to call it, guarantees parts of these projects. So the government of India comes and says, okay, look, this bridge, we don't own the bridge, we don't want to own the bridge, we want to privatize this thing, but we'll guarantee 50% of the principal, we guarantee 60% of the principal, right? Then the credit rating of that bridge or that project will be higher. If the rating is higher, the cost of that project is lower. Okay, so that's great for the guy who's going to build the bridge and operate it. It's great for the guys who want to put money into this project because they feel there's a government of India guarantee. At least a large part of that principle is protected by the government. So be creative. Don't just say, we want to build a bridge, foreign money, where are you? That's not going to work.
Because there hasn't been a good response to the government.
There won't be a good response, I can tell you. But if the government starts to make commitments and says, we'll put our money into projects, we'll give guarantees. You don't put your money anyway, just give guarantees. Okay, that's going to make people somewhat more comfortable. Okay, and I think that at least that's a step in the right direction. The other thing is to try and raise money domestically. I know it's not cheap to raise money domestically, but it's not going to be cheap to raise money abroad. And from an equity point of view, I think, look, any country that's about to commence a real infrastructure cycle is a buy. It doesn't matter what you buy, okay, but it must be a real infrastructure cycle.
You have about 3% of your portfolio right now, of the total assets that Generali has, invested outside of Europe, which is a very small percentage of the assets that you manage. You plan to double it to 6% over the next 3 to 4 years. Sure. Where are you looking at opportunities?
Everywhere. We'll look at emerging markets. We've put money in the EM. We've put money in the US. Just to give you a sense, insurance companies, unfortunately, unlike mutual funds, have to be governed a bit by their liabilities. And my liability book is mostly in Europe. So that affects my asset book. That doesn't mean I can't put assets overseas. I can, and I will, and I am. The question is more how much, right? So, for us, you could argue it was too small a number, okay? And so we're going to, sort of sort that out in the next couple of years. And it all depends on price. I mean, we've put money in US bonds, we put money in emerging market bonds, we put money in stocks. I mean, we'd be buying like the markets I liked, I've mentioned already. We do that because I think that any portfolio needs diversification.
So incremental money will go into the US markets as well as emerging markets?
Yeah, I mean, incremental money will go everywhere. It'll still go to Europe, but it'll also go into other markets as well, because the bulk, I mean, we get money coming in all the time from our policies. So it'll still, the ratio will still be, bulk will still be in Europe, but we look more and more at things to do, and particularly in the US.
Because as I look at the numbers, I mean, another 3% increment in your overall assets would mean $20 billion additional flows going everywhere. So
that's right. Yeah,
which is why I wanted to get a sense.
But I think a lot of it will go in the US as well. So I would balance. I'm not here saying, let's go into, deep parts of the EM or whichever, because we've got some, and we'll continue to add. But I think the US offers just broadly better investment opportunities today.
Okay, I'd read in one of your earlier comments, you'd spoken about, finding value in the forgotten stories. What would be the forgotten stories of 2014, which you think could
I think there were lots of forgotten stories 6 months ago. They've been remembered now, so this is the problem. But I still think Europe's a forgotten story, honestly speaking. You've had a rally, everyone's talking about it now, but no one's really looked at it properly. And I think there are lots, if I was a stock picker, there are lots of forgotten stories in Europe, and so the forgotten stories are going to be, Europe's a huge economy. The EMU is the largest economy in the world. Okay, it still is, I think so, right? There are going to be opportunities, right? And Europe has some great companies. You've seen the big export companies. You have the local company. I think as people realize that Europe, A, is serious about reform, okay, and B, companies themselves are restructuring. The comment you made earlier, when are they going to clean up their balance sheets and all? People are going to get more optimistic. This is not an optimism based on earnings are going to pick up in the next 18 months. This is an optimism based on, you cleaning up your balance sheet, so when growth does come back, you're going to benefit particularly strongly from it, right? And so that's what I'm talking about.
Would that also build a case for looking at Asian companies, emerging market companies, which have exposure to Europe, either in terms of exports, like organic growth, or in terms of inorganic growth? Tata Motors being a case in point in India. I mean, that stock is defying gravity in the way it's moved up, primarily because of Jaguar Land Rover.
But is that because Jaguar Land Rover in China has been making a lot of money, or is it the Europe thing? I don't know. I'm asking you, because they've sold very well in China as well.
Yeah, that's true. That's
I mean, look.
But the market was very strong for them even in Europe.
Look, there is a market in Europe, but there's a very bad automotive market in Europe. It doesn't mean Jaguar Land Rover can't do well, because they've been brilliant at their designs. They've got a lot of kudos for the quality of their cars and the design. So if they keep doing that, they're going to keep taking market share in the top end of the market. So they can do well, even if the overall market goes nowhere. It's a big market, Europe. People forget it's a huge market.
Yeah, no, but my point over there is, would you also look at companies? Does it make sense to look at companies which have exposure to Europe?
It does.
Organically or inorganically?
It does, but like I said, what we were talking about earlier is about companies restructuring, not companies growing at 20 or 30%. So if you ask me, will consumption take off in Europe in the next 6 months? I'd say no. Short answer. But if you ask me, are we turning? And will consumption be much stronger than where it is in Europe in 2 or 3 years' time than it is today? I'd say yes.
Also, one question on money flows, right?
Yeah.
And the trends there, because as somebody who manages $650 billion, or at least oversees these allocations, are you reworking your expectations as a fund manager on returns? Because what we're seeing, and I just went through some research, that the inflows in ETF products have risen considerably over the last 3 years. Mutual funds, they've pretty much beaten the kind of inflows that mutual funds are seeing. The money that goes in and out quickly is the money that's driving the markets. Doesn't that pose a challenge for somebody like you who's looking at long-only capital commitments, either an insurer or a mutual fund house? And doesn't that kind of also bring about a change in your return expectations from the market?
Well, look, first of all, ETFs have been driven a lot by the bull market. In a bull market, I think ETFs attract a lot of capital. They're cheap, okay? They clear play on the index, and and markets go up, ETFs go up. If markets start to go sort of neutral and volatile and flat, I don't think ETF inflows are going to increase, okay? As I was mentioning earlier, there are also 2 types of ETFs, and one I'm more interested in nowadays is, apart from market cap weighted into ETFs, more into equal weighted ETFs, where you have an equal weighting for every stock in the index, and they become more interesting for me. But anyway, so no, it doesn't have a direct impact on what we do. Yeah, there's volatility, but I mean, that's something we've got to live with. I mean, these are volatile times. They're driven by things that are exogenous.
But if the ETF business grows, then doesn't that have some impact, not maybe for an insurer like you, because people need premiums and insurance, but still, doesn't it have some sort of an impact on the inflows in the long-only
They do.
strategies?
I mean, we invest in long-only, we have some investments in hedge funds, but I think they do, for sure. They have. They have. My question is, my question to myself, and the answer is, I don't think you're going to see the same bullishness towards ETFs going forward in the next 3 years. I think you've had people who have ETF funds have done fantastically and deservedly, but I don't think that part of the reason they've done well is because long-only managers, active managers, have not really performed. Okay, but now you're going to my sense is going to see slight difference as you realize markets are. See, when markets are flat, owning an ETF has no value because you're not making any money. When markets are going up, you want the ETF as the cheapest way to get exposure to a rising asset, right? When markets are flat, the cheapest way to get exposure to nothing. So then you're going to try and find managers who are outperforming in rising markets. You've got to look for, in flat markets, you're going to look for managers, and there are always a few managers who do well in flat markets. So that's my advice. Anyone who's got money in ETF's going nowhere, go for a manager. That's what I would do.
Okay, so as I wrap up this interview,
Sure.
I just wanted a sense on how would you characterize 2014? Are you more confident about 2014 than 2013?
I'm actually
Cautious?
mixed. I'm more confident about Europe. Okay, I'm less confident about everywhere else. I mean, and I'm benign on China. Yeah, fourth short answer for you.
All right. On that note, thanks very much, Nikhil, for taking out the time.
No, my pleasure.
With us. I know this is your first interview to an Indian business channel, so really appreciate it.
That's very kind of you. Thank you.
All right, with that, we come to the end of this edition of Global Mantra Outlook 2014. Next week, catch you with another special guest right here from the City of London. Take care.
Although you do have the uncertainty of an election next year, I think there is far more potential for positive surprises for India over the next 6 to 12 months than there are for negative surprises. I think what is a fair assumption, a base case assumption, is whatever government is in place after the election is likely to be stronger and more focused on reform than the government has been over the last 12 months.